Association is Bangalore Valuers Association is proud to announce a two-day physical session in Bangalore, December 15th and 16th. Official announcements will be made, but this is just to help you to temporarily block your calendars. And yes, we will make this announcement shortly. And coming to today's session, Mr. Ramakrishnan is a real fighter. Even though his health was just recovering, he accepted our invitation to conduct this session. I request now Kusum to formally introduce today's speaker.
Good morning, ladies, gentlemen, and fellow valuers. I am Kusum, and it is my privilege to welcome this morning's speaker, Mr. Ramakrishnan, who will be regaling us on responsibility valuation. We all know that environmental, social, and governance issues are playing increasing role in companies' decisions around mergers, acquisitions, and divestitures. But how do these factors link to corporate performance and deal potential? These are some of the things that Mr. Ramakrishnan is going to walk us through. Talking about Mr. Ramakrishnan, he is a corporate financial professional. He's based out of Bangalore. As a part of his work, he's associated as the founder director in a company which actively assists startups, small and medium enterprises, and NBFCs, in non-banking financial institutions, for financial management, internal controls, and risk management. He is an expert in business strategy, financial management, financial services, internal controls, and risk management, as well as on business valuation. He has held leadership positions in reputed organizations like Kotak Mahindra Bank, where he was a product head for working capital financing division, and prior to that, he was a business head for infrastructure finance division. He has had, he has had rich entrepreneurial and advisory experience. He currently holds board position in 2 startups. He also holds strategic advisory role in various companies which are into NBFCs and fintech, security tech companies, infra tech companies, and alternate investment companies which focus on the real estate sector. He is a pro bono advisor and mentor for IITstartups.org, a startup accelerator based in USA as well as in Bangalore. He has assisted in growth business plan strategies for more than 360 startups and SMEs. He is an alumnus of IIM Bangalore. He is a postgraduate in commerce from University of Madras and a postgraduate diploma in financial management from IGNOU. And sir, we really admire your fighting spirit. To hear from you this morning. Over to you, sir.
First of all, it's my pleasure, and I thank Subraidu and team, Shilpa Madam and Ravindra, to have enabled this session. Thank you so much for this. And unfortunately, the last time I couldn't make it, but I'm happy to share my thoughts. This is not an expert session. This is more of sharing our thoughts. We have a team of people who are focused on the environment, social and governance side of the businesses. I have with me Shamant Murthy, who is the CEO of Yasil Technologies, as well as Sharik, who is the Chief Technology Officer of Yasil Technologies. Alongside, we have our advisor, Mr. Navneet Sharma, who is Navneet Kumar, who is with one of the leading Big Fours and focusing on ESG consulting as his core professional activity. We also have another advisor, Mr. Mohan Ramanathan, who is also a very good friend of mine and working very closely with me on various initiatives relating to the clean tech energy sector. I'm happy to take this session. This session has 3 sides to it. One of them will be the introductory session to what we are discussing about the ESG implementation and integration of ESG parameters within the valuation spectrum. The second would be a brief sharing of the poll questions in order to ignite thoughts among each of us. And thereafter, we have a session by my team, Yasil Technologies, who will take you through a complete demo of the tools which are available to assess, evaluate, and monitor ESG strategies as well as implementation. Thank you. I will require your approval for sharing the screen. I have a presentation.
Please go ahead.
That. Yeah, thank you. Yeah, like we have already mentioned, this is a session on responsibility valuation. When I say responsibility valuation, it is more related to the responsibilities among the professionals around in today's session, as well as the worldwide. From our side, it is more of a knowledge session. Whatever we have imbibed over our brief journey with respect to ESG, and our personal the personal passion to address the three concepts of ESG: the environment, social, and governance, while analyzing the impact with respect to the target companies, target sectors, so on and so forth. The agenda for today is three-pronged. For the first one would be an introduction to the incorporation of ESG as part of the valuation methodologies leading to responsibility valuation. There's an insight into tools to assess and monitor ESG strategy as well as performance, and a poll questions relating to the session. The first and foremost point which we want to bring on table today is the need for sensitization. When I say sensitization, each one of us are responsible for what we provide as a world to our next generation, and in whatever way we are is possible for each of us, we expect to contribute as part of this journey towards a net zero or a clean world, so on and so forth. If you recall, in 2015, there was a German automobile major which admitted to having installed emission cheating devices to address pollution control measures. So these devices were part of the cars which they were selling, and they were sort of not giving enough evidence of pollution which was being emitted by these automobiles. And the result had a three-pronged damage. One was the environmental damage, which was very significant in terms of the carbon emission which happened. The second was the societal impact, which eventually is because of the pollution as well as various other things which emerged post these disclosures. And the third, obviously, emerged as a significant governance lapse within the organization, and the resultant impact of these governance lapse. The result was a $33 billion in retrofits and regulatory penalties. Totally, there were 11 million vehicles which were affected as part of the worldwide impact, and about $28.5 billion in negative market capitalization. So net, this not only affected the organization on the whole, but also a significant portion of the society, and also through many questions as to how companies are being governed. And that essentially sort of threw open so many things which came out in the open, and sort of sensitized the whole world as well as the companies related in the particular sector. Having said that, this scandal also highlighted the failure of valuation models used by investors, analysts, so on and so forth, to capture the full range of risks posed by environmental, social, and governance factors. I would like to take a few steps behind. Even within the professional spectrum of valuers, there's many a time it so happens that the investors influence the valuation outcomes. There could be companies who are the beneficiaries of these investments who could be influencing the valuation outcomes. And many a time it so happens that the particular transaction is being given more importance rather than the sensitivity towards responsibilities of the fiduciary responsibilities of every other professional out there in this spectrum. The critical aspects which typically get missed out. Okay, so whenever there is a valuation transaction, which valuation assignment which happens from a valuer, the first and foremost aspect which is being considered are all related to financial, is all with a financial lens. All of the financial parameters which traditionally are hindsights, thereafter converted into forecasts, so on and so forth. But very little is being looked into what sort of governance, what sort of compliance, what sort of effects or ill effects which the companies are essentially doing with respect to their value, with their disclosures or their overall governance of the organization, so on and so forth, is most of the times missed. If you recall a couple of recent incidents, one was in an edutech company where there's significant lapse of the basic accounting principles itself. The company did not disclose the audited financials for 2 full financial years. And there were a spate of resignations which happened at the top levels of the company. Apart from that, there was a significant number of people were retrenched because eventually there was a lot of crunch which was being seen in the organization. Close to about 5,000 people were removed, and none of these were being factored in the valuation. The valuation, in fact, increased by $1 billion. And eventually we were shown that it is actually the company is performing very well. But the impact which happened was there were a number of the auditors had decided to step down, and there was a significant backlash on all of these things. It so happened that the valuation thereafter, there was a down valuation to the extent of about 70-odd%. There's a lot of social media backlash on the company. There were a lot of issues which the company had to undergo. That essentially is the S and G of the ESG, not necessarily the E part. But when we look at the overall spectrum, we have to consider all the 3 aspects in order to put forth a valuation defense. The second incidence was about a very large financial services company, a bank in India. There was a social media post which showcased a major problem with respect to the way the organization behaves with their employees. It was a very small incident, but it was overblown. But it also sensitized us to the fact that there are a lot of areas which needs to be addressed by corporations while addressing their overall business approach, which includes business environment, which includes the environment within the offices, which includes the governance, the type of people they are employing, and their respective decisions, which eventually affect every one of us, including the shareholders, investors, so on and so forth. Another major risk, which is which has been analyzed over the last few years since ESG took significant importance in the overall scheme of things. The financing emissions is something which is probably overlooked in India, okay, but worldwide, this financing sector, whether the banks or non-banking institutions, they are contributing to funded emissions, which is over 700 times greater than their own emissions. So when I say funded emissions, they are focused on the type of companies which are emitting significantly higher emissions, which are significantly of high risk to the environment and the people out there. The financing industry's contribution is major, whether it is in the agricultural sector, whether it is in the transportation sector, whether it is in the manufacturing sector, so on and so forth. There has been a significant increase, and that causes a major concern, assuming that whether at all the financing industry is really sensitive to what they are actually providing as a world after them. But the most incriminating factor is under half of these disclosing financial institutions are reporting actions to align portfolios with a below 2 degrees Celsius world. So there's a 2 degree climate change effect which is being factored while understanding the financing emissions. There are only half of the reporting institutions are actually proactive. That is creating much more heartburn. That's much more. We are looking at it at a significantly high risk which is emerging. Due to this, the financial institutions are actually underestimating most of the significant climate-related risks, and the potential impact is over $1 trillion. And this study was done as recent as 2021, which means that even after understanding the major risk aspects, there is a tendency to sort of brush away these things in the quest for better profits or better monetary benefits. So that essentially poses a question for all of us, the evaluation professionals, as more importantly. What should really change? Okay, and we all are aware about the traditional approach where business valuations were predominantly based on the market and the industry forces, with significantly focused on the financial lens only. And these, as all of you are much more aware, are commonly used the discounted cash flow mechanism, the key cash flow drivers being the sales growth, the new product or the service development, the market penetration and market share objectives of the target company. Apart from this, we look at profitability margins, improved cost of production, improved supply chain relationships, improved exchange dynamics. And thereafter, we look at the investment levels and the decisions, typically the working capital, or for that matter, the capex investments, and then related to asset turnover thresholds and efficiency, so on and so forth. This approach needs to be changed, but the change is not necessarily a significant change, but a sensitivity change, wherein we are looking at business valuations purely based on the market and industry forces, but not only with a financial lens, but also incorporating ESG lens. Here, we are trying to understand and analyze the pre-financial or the non-financial information. This is a very critical aspect of the whole piece. In India, the SEBI has mandated the key organizations. The first level is 150 top listed companies in the company. They have to undergo a business reporting mechanism and responsibility mechanism, a mechanism which addresses all of their initiatives with respect to net zero, so on and so forth. This is a regular annual report. All of these are available publicly. Our approach would be first of all to try and understand these reports in its entirety, understand, then integrate these into market approach, that is sales, new product, service, or market penetration and market share. When I mention this, the understanding is to use these analysis of pre-financial and non-financial information and try to understand whether they impact sales growth, whether they would impact their new product or service developments, or whether it would impact their market penetration and market share objectives. One of the examples which I would use is a recent development in the EU countries, where there is a climate tax which has been imposed on companies which are traditionally from the emerging countries, and that has significant impact on Indian small and medium enterprises. While one could always argue, SEBI has mandated the top 150 going down to 1,000 companies over the next few years. Why SMEs? How can SMEs be impacted? That's the that's a larger risk which is facing our industry. More importantly, all of the three steps related to ESG reporting, scope 1, 2, and 3. Well, looking at scope 3, it percolates down to the last mile supply chain. And that is where India's small and medium enterprises broadly fall under to. They are the supply chain for multiple segments, and eventually all of them, right to the last small medium enterprise, will get affected through these disclosures. And that is something which we have to sensitize ourselves. It is not only the very large corporates which have the tools or the wherewithal to address these things, both in terms of implementation of strategies as well as investing towards reduction in emissions, so on and so forth. It is also necessary for the small and medium enterprises to look into this. One other example which I would like to take here is I was consulting for an organization based out of Kerala. These people are there's a very small company of about 125 crore turnover and focused on coir-based products and services. There was a notice from one of the, a significant portion of their turnover was exports and predominantly to the US market. There was a notice by one of the regulators, US regulators, who had to do an audit on the company. The first and foremost thing which they found out, that the company was having a factory which had a roof of asbestos sheet. And that was a significant lapse of the company because it was considered as one of the key parameters under which ESG is being monitored. The second parameter was the usage of power. The company was using the traditional conventional power. The immediate impact was the company had to change their power source from the conventional energy to renewable energy. That impacted, there was an investment impact by the company. They had to go for a 1.5 megawatt power plant, a rooftop approach. That essentially changed certain dynamics. But having said that, the decision of the company was pretty proactive and they had gone ahead with that. Incorporating these decisions is very critical from a valuation perspective. How does it impact? First of all, the reduction in power costs is a significant impact, which eventually reduced their cost of production. The impact also was from a social side because they were expected to provide better rooftop with respect to housing their factory workers. They were also looked at how they were treating their suppliers, predominantly micro enterprises, which included women, poor women, preparing and providing raw material for coir-based products. And that was a real case study which I personally had to intervene in. Then all of these findings thereafter get integrated into the income approach, wherein capitalization of cash flows, or for that matter, in your discounted cash flow, improved supply chain relationships. So when I mentioned about supply chain, this also is something. So we have to evaluate the last mile supply chain of the large organizations in order to understand how it could impact their market growth, market penetration, more importantly, whether they will be able to reach out to larger countries for exports, so on and so forth, due to these changes in the supply chain relationships. And overall, this would enable improved exchange rate dynamics. All of these need to be factored while looking at it from a business valuation perspective. Another approach is to factor the risks and the potential changes on account of the proactive ESG strategy with respect to implementation in line with the investment levels or the decisions related to that. While we look at this, we see what sort of changes this will impact with respect to asset turnover thresholds or efficiencies. As I mentioned earlier, the supply chain risks and opportunities, and also the ESG risks and opportunities. One of the key things which are measured as part of this is the carbon emission. And there are tools which enable the practitioners to understand carbon emission through various modes, factor the monetary loss or monetary gain with respect to carbon credits, and that eventually is taken as one of the factors to address the evaluation, the fair value eventually. While integrating the concept of ESG into market approach, we recommend a 3-step approach. Some of these approaches have already been published in publicly available documents, so we are not saying anything new. It is more of our internal research, wherein we have identified multiple sources of publicly shared information, as well as understood the approach by the respective corporates during part of our portfolios. We assess and understand the relevant criteria, ESG criteria for a given industry or a sector. All of these tools, which will be shared to you during the course of the next session, are available industry-wise, sector-wise, as well as country-wise. So it is very important as a valuation professional to assess as well as understand these relevant ESG criteria while approaching an valuation exercise with a target audience. Thereafter, we compare the subject company in relevance to the criteria, not only with respect to the peers. There could we want to compare the subject company with respect to their peers, but also there could be certain times when we want to look at a replacement investment. So at that point in time, it may not necessarily be the industry or the sector, but it could be from a different industry, different sector, and we try to address whether a particular investment decision is beneficial or not. And the third approach is to calibrate the valuation parameters. For example, market multiples, the price to earnings, the EBITDA multiples, the sales multiples, in relation to the peers in the industry or the sector, or in relation to a target replacement or investment decision. One of the things which we have to understand is there is no major difference with respect to the traditional approach. However, the sensitivity is checked with respect to the ESG lens and not just a financial lens. So all of the parameters which we have identified as relevant to ESG criteria are factored within the market approach, and then we arrive at no change model versus a change model, and then try to see what could be the significant change which are emerging. The most commonly used or most appropriate method of valuation, in my personal view, as well as most of the others who are practitioners, is the income approach. Because this not only gives an idea into the hindsight, but also has various objective methods to understand whether our assumptions are in line with what the outcomes are, and also to enable us to forecast in a more proactive and objective manner. One of the things which we all have to understand is most of the ESG factors, parameters, are subjective in nature. The approach has to be essentially how to try to make them objective and more materialistic in nature. The key challenge is to understanding the reliability of future cash flows and the inherent risks. Because of this subjectivity, this key challenge is getting more pronounced. Thereafter, incorporating the risks, requisite premiums or discounts based on the understanding of the ESG factors, both implementation and risks and management thereof. It's very important for us to understand that after having addressed the valuation exercise in its entirety, there are premiums which are incorporated. It could be a country risk premium. It could be a specific location risk related premium, or an industry risk related premium. It is important for us to also factor our ESG risk premium. But that approach in itself may not necessarily give us the desired outcome. The valuer's role is to assess to what extent the subject company's forecasted data integrates the risks and opportunities within its projections. What happens with respect to a particular decision to change to a renewable energy mode? There could be a significant impact on the capex, but there could be a corresponding benefit in terms of the cost of the power. That eventually will result in a change in the cash flow. There have been companies who have already taken proactive steps. Say, for example, in 2013, 14, 2015, there are many companies who had provided power purchase agreements and gotten into arrangements with suppliers of power, but the cost of that power was significantly high, 9.5 rupees per unit. There was not much of a difference between what is happening currently, but they were looking at it more from a benefit with respect to ESG. Having said that, that has a negative impact with respect to the financials. More importantly, with the cost of renewable energy significantly lowering, sometimes as low as 2.5 today, is there a possibility of change? So when we assess these things and provide an insight to the owners of these assets, it will be of significant value. Having said that, we also have to incorporate the potential risk of having to replacement, because most of these power purchase agreements are long-term, say 25 years. And anything with respect to withdrawal of such an agreement is directly impacting the financials, because there are penalties which are inbuilt within these power purchase agreements, and that could be a significant cost to the company. So all of these matters have to be looked into while integrating ESG into the critical part, which all of us professionals should understand, is the impact is so significant that our the access of knowledge has to be significantly broadened than focusing only on hindsight financials. Important points for incorporation of ESG into cash flow. The general approach is to provide a risk premium. High risk ESG, then I provide a premium for that. It is practical, but extremely subjective. Hence, we recommend incorporation of ESG into cash flow through risk adjustments relating to environment. For example, based on the 2-degree scenario in climate change, the net effect on the cash flow is based on the forecast for a beverage manufacturer in relation to high costs being incurred on water usage. There have been instances where recently I was in a consulting assignment for an M&A in a hydropower company. A significant portion, it's about a 75 megawatt portfolio. A significant portfolio of a portion of this 75 megawatt portfolio was in Himachal, Uttaranchal, and Uttarakhand, and so on and so forth, where the risks of climate change are significant evidence for all of us. Over the last 5 years, or for that matter, over the last 10 years, right from 2013, when there was a major cloudburst and flood happening in Kedarnath, a number of such incidents have been continuously happening. And when an organization is focusing significantly in that territory, the chances of the failure of those power plants significant, and more the risks are significantly high. These are all evidence. There are a lot of evidences for this, and everything cannot be only based on cash flow. So hence, we while approaching a valuation exercise for this M&A activity, a major portion of this risk was factored. Similarly, there have been instances where landslides and floods have sort of broken down the national highway in India. Due to that, at least a month has been lost in certain areas with respect to flow of traffic. That eventually affected the organizations which were on the build, operate, and transfer mode with respect to their annuities, or for that matter, with respect to their collection of tolls. That had to be factored in addressing a particular analysis on a road construction company which was having road assets. The second, in fact, important factor is the social aspect. For example, the impact on revenues and cost-related cash flows due to employee unrest in industries such as garment industry. This industry predominantly is known for poor labor and social measures. It is very essential for us to keep factoring and also look at history of how many times there has been a backlash, and how many times there have been slowdowns in production, how many times there has been a stoppage of production, so on and so forth, due to these incidences. The third aspect is the governance. For example, the impact on cash flows in the form of fines, increased taxation imposed by regulatory authorities due to weak governance policies of the organizations. This is something which we have to be sensitive to. There have been many an instance where, for example, Google itself there have been a lot of penalties which have been imposed on Google because of their so-called negative practices with respect to privacy and so on and so forth. If you really analyze, in the last close to about a decade or so, there are multiple instances of Google paying penalties. That also had to be factored while approaching the analysis on Google. Similarly, practices with respect to conduct of business. For example, a very small thing in banks and financial institutions. Reserve Bank of India has the guidelines for collection. Every minute activity with respect to an approach for collection from defaulters, so on and so forth, is monitored. It has to be reported. It is a very proactive way of approach. There's a very clear process. There are guidelines on the type of people to be employed, the type of training to be imparted to these people. Any lapse in that is a significant lapse which is considered by Reserve Bank, and the penalties could go as high as 1 crore of rupees. There are multiple such instances which have happened. The most important factor in ESG implementation within the financial, within the valuation parameters, is the materiality aspect. it is important for us to know what is reported is clearly assessed. What is the impact is analyzed, and thereafter the forecasts are addressed and the results are compared. Materiality is a key concept in sustainability reporting, as it helps companies identify the most important sustainability issues to report on, and also provides stakeholders with more meaningful and relevant information. So this is how one tries to address the subjectivity part of ESG. Eventually, for all of us, the trust is very important. However, as valuers' responsibility, especially in the fiduciary side, we need to probe. Most of the times, that is where we miss out. It is all transaction based, and there's a lot of pressure. There's a lot of influence by the investor or the company which is the beneficiary of that investment to downplay certain key things. Even some things as compliance, the regular compliance which we typically require to do. I was in another M&A transaction where the company had not filed for professional tax for a complete period of 3 years. The company's defense was we had already exited Karnataka. So we did not know that we had to do that. But it came out in the due diligence. So that is a significant portion which is not probably looked at by certain valuation. Because most of the time it so happens that there is another professional who looks after that. It is not intentional. It is more of an influence, and it is transactional based. But it is very imperative for us that we have to ensure that the probing aspect of a valuer is there. Most of the times we are confronted with saying that, are you an auditor? Why you are just a valuer? Why do you want to get into so many things? But it is essential for us to fight back these things and emphasize the importance of the valuers in all of this. More importantly, I would recommend that as the association, you should reach out to the IBBI to see how we can implement these fiduciary responsibilities, as well as the influence of the valuers to be much more than what it is today. While approaching the materiality assessment, we look at the sector, industry. There are tools which enable us to understand this. There are very specific parameters which are mentioned by the regulatory authorities of multiple companies, including multiple countries, and including UN, IMF, so on and so forth. The company and the specific factors with respect to materiality has to be assessed. The location where the company or the factories are situated and the country, so on and so forth, has to be assessed. The governance with respect to the organization, the sectoral thresholds, or the sectoral performance with respect to governance, the governance within the country, their responsibilities with respect to climate change, the impact of climate change in these areas, the location, country, so on and so forth, the impact of climate change with respect to that company, like I mentioned, the hydropower company, and the overall investment horizon. When I look at investment horizon, it is important for me to also understand what am I factoring as premium. Is it in relationship with all of the other factors which I mentioned? Is it in relationship to overall general investment horizon being extremely positive, like what is happening in India today? So some of those times, we may look at lowering certain criteria, essentially because those can be taken care of a significantly better performance with respect to the financials. While as much as we talk about the responsibility, there is a factor which we also look into, the risk and reward. And the reward being significantly higher can sort of offset the risks involved, right? So that is where we look at the investment horizon. I would also like to delve upon some of the best practices with respect to implementation, integration of ESG. It is always coming with a degree of difficulty. So translating ESG factors into future cash flows with a high degree of conviction is generally difficult. However, we recommend to consider the sensitivities of all the ESG factors to the overall valuation and look at different scenarios. And these scenarios could be normal, ESG, within ESG, you look at how it could impact only if the environment factors are put into, or only when the social factors are considered, or when the governance factors are taking more predominance. It also helps the investor gain better insights into the materiality and the potential impact of ESG on the overall evaluation. The recommendation is to not only factor, but also provide the insights on why we have factored with examples, so on and so forth. Within this, we look at, so for example, if there is a binary type of ESG risk, we look at the business as usual scenario and a scenario in which the ESG issues are materializing. With this, we could sort of arrive at a much more balanced approach. It is also recommended that incorporation of all of the probabilities for both the scenarios and thereafter address the fair value of the company. Some of the, while I mentioned the difficulty, and the difficulty is essentially because there are not, it is assumed that there are not many methods and tools which can be used to address the incorporation of valuation ESG into valuation methodologies. However, there are many tools, not only from the regulators themselves, but also multiple organizations, startups have done this in a very proactive manner. It is important for us to also understand them. The forecasted financials, for example, with adjusting revenue and margins. When I look at forecasted financials, we try to incorporate the impact and then look at adjusting the revenue and the margins depending on the impact, whether positive or negative. Then the forecasted financial ratios, for example, an impact on the financial statement ratios based on the impending action of, say, penalties affecting net profit margin. The decision with respect to capex, addition of new capex, that could have an impact on your overall financial forecast, so on and so forth. It could also impact interest cost, because it could have there could be a loan to address the capex. Valuation multiples, for example, a potential change in the PE multiple based on an ESG negative scenario. Many a time, PE multiple is used only for listed companies. But even unlisted companies, it is essential for us to understand similar listed companies and see how we can compare the two and factor a PE multiple based on a negative ESG scenario or a positive ESG scenario for that matter. We also recommend that these be used in valuation model variables. For example, providing a scoring model based approach, essentially factoring ESG parameters and their respective impacts. Finally, the security sensitivities and scenario analysis, for example, comparison between non-ESG versus ESG impact scenarios, which I've already shared earlier. Apart from this, while we look into the next session where the tools will be shared, those are also very essential for you to factor, for you to enable to factor as part of all of these which I mentioned. a quick understanding about the incorporation of ESG into forecasts. As we all know, the cash flow items, operational revenues. Thereafter, we look at the decrease in revenues essentially because there has a poor treatment of employees, reduced sales. That is essentially a social factor. Thereafter, we arrive at the ESG revenues, post which we have the operational cost and the operational EBIT. Thereafter, incorporating the operational taxes, basis which we arrive at the net operating profit. There is an incidence in this organization with respect to governance, which resulted in an additional tax on account of penalties. That is reduced, basis which we get the ESG net operational profit minus taxes, which is about whatever the figure is. Thereafter, you factor back the depreciation and amortization. You reduce any incidence of investment with respect to capex or net working capital. Thereafter, again, reduce the additional capex due to a mitigation of a climate change risk. And this is in relation to the E part of ESG. And finally, we arrive at the ESG free cash flow. Broadly, a table which most of you understand much better than me. Wanted to see sort of sensitize here towards how we can sort of look at from a statement point of view. Finally, we come to the addressing of the subjectivity. We all know that there is a significant amount of subjectivity which creep into most of the analysis, whether it is the traditional approach or the new approach. However, it is important for valuation professionals to incorporate as much as information possible which enables objectivity. Here, we recommend that there is a weighted average valuation outcomes are being considered. When I say weighted average, there is a weighted average of all of those which related to factoring all the ESG parameters and factoring only the E part of ESG. Thereafter, we look at, as I have already mentioned, the S factor due to the staff backlash, the G factor due to additional taxes, the E factor due to additional capex investments, or the other side where you factor only the E factor for additional capex investments and sort of provide your own factor of weighting, whether it could be 50% each, or if you see that there is a significant risk which is emerging because of ESG factors being integrated, you could add a significantly higher score for that purpose. Finally, we arrive at the balanced approach. As we all know that there is a lot of art also embedded into defense of valuation. It is more of a storytelling. While the storytelling is not necessarily creative, there is a background to every such valuation story, and that background essentially is based on science. And hence, we say valuation is both an art as well as a science. Much of the ambiguity is reduced by concentrated analysis and near perfect assumptions. But all of these require the supporting mechanisms of tools, models, so on and so forth. It is of paramount importance that managing risk while managing risk is extremely important and it is normal, but addressing the impact of ESG is of paramount importance. It is not only about financial side of the whole story. It is a responsibility, each one of us, whether fiduciary or collectively, individually or otherwise. With that, I conclude this session. We will have the polls as well as the tool sharing session. However, I would also like to sensitize the opportunities which are available for the BVA members within this spectrum. There is a significant opportunity with respect to ESG consulting. we have only scratched the top of the tip of the iceberg. There's a huge opportunity within this space. Incorporating ESG as part of valuation models and parameters. This is a very important exercise, which I would recommend the BBA members to start, at least see how to approach this if you have not done earlier. I would also like to recommend the BBA to enable a research-based approach, essentially through collaborations with ESG consultants as well as platforms, thereby ensuring that the cost of implementing these parameters is significantly reduced, because most of these organizations are startups and they want something which would through the influence of the Bangalore Valuers Association, they could also enhance their brand image and so on and so forth, and be more proactive to their respective clients. It is a win-win for both the sides. There is a significant opportunity which is emerging. If you would have recalled the finance minister mentioning about carbon accounting, it is a very sensitive part. It not only enables opportunities, but is also increasing the fiduciary responsibility of each of us. It will eventually be an opportunity for us, because we will also involve ourselves in carbon pricing, carbon valuation, so on and so forth. That enhances the spectrum of services which you as valuers can provide. Enabling energy transition through a consultative approach with clients using valuation models. Many of you would be associated with multiple clients. But when you look at it from a consultative approach, rather than an exercise just for an outcome, it would be a significant change from how we approach clientele, how we approach our own profession, both with responsibility as well as opportunity. It is a tool which enables value creation rather than just valuation, right? And finally, we also have opportunities in the social audit side, where you could collaborate with social auditors, or for that matter, implement social audit as part of your own consulting services. All of these six-pronged, I'm only able to list six-pronged approaches are available for the members to look into in future. Thank you, everyone. We will continue with the session. I'm open for questions. Happy to be with you. Thank you.
Sir, I'm of the view that it's just a matter of time that each of the valuers, will question by any statutory authority on any parameters, on any risk factors, which would have materialized by then. So it is more prudent for us as a valuers, this is actually my takeaway, but I'm still, considering how we can implement it. Can you give a little more examples for some, startups, how can we consider this conventional? Yes, we got, little established.
Yeah.
Fine, but these startups also come with a lot of ideas.
Yeah. So one of the things which we would like to put forth over here is, from a practitioner's point of view, a significance is with respect to the flow of the assignments. Okay, this is a very, very important thing. It may not necessarily be a startup area or a small and medium enterprise area, purely because of how all of these things are approached. Okay, so it will boil down to the 150 listed companies, because there is a regulator who has sort of mandated only those 150 listed companies. Thereafter, they have looked at 1,000 thing, which will eventually come in probably 2025 or thereafter, 2026, if I'm not mistaken. That sort of restricts us, the valuers, the value and valuation professionals, from being proactive, being much more than what they are otherwise expected. But what essentially is coming forth, and this is coming at a very rapid pace. Okay, there is a lot of thing with respect to how companies approach their supply chain, and each of them, for example, since I'm also associated with this company, Azure Technologies, there's a lot of requirement which is actually drilling down to supply chain. And that is essentially what each of us can look forward to, not only from with respect to valuation, but also from consulting assignments, so on and so forth. Implementing this, while tools are one of the things, but essentially this has to come from within. Okay, and that within is the association in itself, because independently it will not be possible for each one of us to take it independently, because not only the costs are allowed, but it is more the influencers, which are the investors or the beneficiary company, which sort of restricts our approach. They would not want so many things to be disclosed, or there could be a sort of a withdrawal sort of a syndrome, which will not allow us to implement them in its entirety. But when it comes from the top, that we will also look at these factors, and that becomes a fiduciary responsibility of the association. And we are happy to be closely working through the organization and see how we can implement this. There's another organization which I'm, in fact, a very good friend of mine from Australia is running this. His is much more comprehensive, because most of the nature of the approach from the companies abroad, whether Australia, US, or for that matter in EU, is much more comprehensive. They're considering each and every aspect of ESG. Or rather, they are more proactive to the vagaries of what is going to happen in future. This company also implements, they have tools with respect to risk management, not only at the company level or the corporate level, large corporate level, but at the last mile supply chain level. So such tools, partnering with such organizations, there are organizations which provide tools for assessment of carbon credits. So okay, that all will sort of enable the organization to be, the association to be more prone to, or associated with such companies will help them much better. Right?
Good morning,
Sir,
sir.
I have a question.
Yeah. Who's this?
So, this is Kusum. So I have a question. So the thing is, the large companies like Microsoft and Google, they have data centers, right? Do you think having those data centers is actually affecting the environment, because there is a lot of power consumption that is happening?
Yes. That is it's a good. There's a significant impact on that. Not only that, but also the waste management practices, the e-waste management practices. All of these are essentially part of the ESG parameters, and many a time all of these have to be reported. The data centers are now, there are many areas, many countries which are mandating data centers to use only the renewable energy, and that is a big opportunity in India, essentially in Karnataka, Bangalore, and because there's a significant opportunity with respect to data centers that is also looked at as an infrastructure sector. There is a proactive, focused approach with respect to companies who are in the EPC of solar, essentially rooftop, to target such organizations. The mining industry is one such segment, where a significant portion of their mining, quarrying, for example, more than 15% of their costs are related to not for 15% of their revenue with respect to power costs are essentially because they are using conventional or DG sets to enhance productivity. This is an opportunity for the EPC companies to reach out to those quarries. But more importantly, for the large quarries, this would directly impact them. Not only that, the large organizations which are in the road sector, which use the output from these quarries, for example, stones and so on and so forth, will also get affected, because from the supply chain point of view, the scope 3, where last mile supply chain is looked at. Is this supply chain of quarry stones using conventional energy or renewable energy? They will be forced to use renewable energy. But that force is not only with respect to looking at it from a cost point of view, but also an opportunity for the company, because there is a significant reduced cost with respect to usage of renewable energy, thereby having better financials, right?
Yes, so you were talking about mining. Even this cryptocurrency mining could also actually be a threat to the environment.
Yes. That is essentially a big problem. It is not only the conventional energy manufacturing and so on and so forth, but also the new age industries of crypto and all of that.
Thank you for the clarification, sir.
Yeah, and there is a question by Ganesh Ramani. The existing historical financials already captures such impacts of labor unrest or natural calamities. So does that mean ESG value is essentially a value already embedded in traditional value? Excellent question. Not necessarily. It is only as a hindsight which is being shown. Valuation is not necessarily an exercise of hindsight financials. Some of them could use the hindsight to address M&A. If I have to purchase, I would look at what the performance was in the last 12 trailing months. And going forward, I will forecast, and finally I will give a price. But all of this is essentially what do I pay versus what I get? Not necessarily factoring the impact thereafter. When I say ESG impact, all of this is a futuristic thing which have to be necessarily factored in the forecast. Most of the time, reports are just information, but that information has to be used by us in proactively so that we can use them for forecasts. Reports, again, are basic regulatory compliance exercises. They are not necessarily responsibility statements. They are not necessarily intentionally responsible. But as professionals, we want to see how it could impact it. When they capture this to show their existing and historical things, it is only a defense mechanisms. I have not performed because of COVID. I have performed because there was a flood in Kerala. Can we look at a history of what has happened in Kerala? How many times there have been such incidences of flood? It could be from 2016, almost every year there have been floods, and at least 1 or 2 months of productivity has been stopped. Going forward, will there be an incremental effect, basis which we tone down on our financial assumptions? All of you know that forecasting is aspirational. It always comes as an aspiration of the company which is a beneficiary of such an investment. But when we look at as professionals, we have to be extremely objective. We have to look at all of the risk factors, all of the opportunities before we finally arrive at, right?
Yeah, if I understood that answer correctly, Ganesh sir, what Ramakrishnan sir is saying is the fact that it is included in the historicals need not necessarily mean that whether it is adequately addressed in the forecasts as well.
Absolutely.
And that is where the due diligence required from a valuer would come in.
Absolutely.
Is it adequately incorporated in the forecast financials or not, is where the valuer's due diligence comes in.
Correct.
Yeah, it can't be taken as a given for sure. It has to be validated, right?
Yeah. Can I continue the question? So just to
Yeah,
get
sure,
some.
sure, please.
Yeah, I think the principle that I was asking here is,
Yeah.
today there are forecasted financials given by the company as a management. As a valuer, we look at the financials both from a buyer's perspective and the seller's perspective, because we are supposed to be neutral.
Correct.
To that extent, independently, when we look at the financials, we look at the historical capability, we look at the potential future capability, we anyhow look at all those aspects.
Absolutely.
Right?
Absolutely.
So when we are doing that assessments, today when we are doing those financials, we are already looking at the trends of any labor unrest, looking at the potential future tax that anyhow we are considering today.
Perfect.
Now the question therefore is, so
Yeah.
today whatever value, unknowingly or whatever, we are embedding the value of the ESG
Precisely.
impact.
Precisely. I'm totally in agreement with you.
Yeah, so therefore,
There have been proactive valuers who are doing this, not necessarily with an ESG lens, but from a how it impacts from a financial thing. But the key over here is when you start looking at it thoroughly, when you start looking at it in a very focused manner, the premiums or the discounts which are typically factor while arriving at your valuation, whether it is in the CAPM or otherwise, it will get more pronounced. That is the thing. So that is where the art comes in, right? So I'm in total agreement with you. Many of us would be factoring it, but the recommendation is to also factor this as part of the model right at the beginning. And all of our questions are to the target company is directed in this manner.
So the second part of this part is this is where we are talking when you are looking at the income approach.
Correct.
However, I think market approach is the best approach if we are able to satisfy the larger similarities in conditions. So
absolutely.
So in the market approach, are we supposed to presume that market has already done a price discovery?
No,
keeping in
not
mind
necessarily. Not necessarily. Because in market approach, we are looking at comparatives.
Correct.
Okay, when you look at comparatives, the probing factor of whether that comparative is actually true for our thesis is also to be done. And we many a time it so happens that the comparative itself is overpriced. That is when we sort of look at more in a much more probing manner and factor the respective premia or the discounts. It is not necessary that it has already been factored. We are presuming, see, most of the times when you look at it from a stock market point of view, there are multiple other factors which are also affecting. Okay. Now, the noise which we are all hearing on a day-to-day basis about one of the very large conglomerates in India. Okay. Everything points to a lapse in governance, whether insider trading or otherwise. How much of that is really factored? Is the ESG part being factored at all over there? Maybe, may not be. Okay, some of those people who are on the other side of the spectrum where they want to be conservative or want to bash the corporate are taking the completely negative approach and factoring much more than they ideally have to factor. On the other side, the more bullish people are just overlooking all of these factors. If it were any other organization, there would have been a definite backlash, there would have been a definite penalty, right? Because we are all privy to some of these things. For example, what happened with the Z television promoters, both Pawan Kumar as well as the other gentleman. So they have been barred by SEBI, right? And essentially because there was a significant incidence of insider trading, a proof of insider trading which had happened. So that is where I'm saying that may not necessarily be factored, but for us, while looking at a comparative, we also have to see how that comparative is really, how are the parameters being looked at. That will essentially help us to be much more balanced. I'm not saying that this is the final thing, but it's just a recommendation.
Thank you, sir.
Ramakrishnan sir, this is Vijaya. Can we launch poll questions?
Yeah. I understand valuation. There's someone who has asked for what are the opportunities for social auditors. Mr. Shivaprasad, there are multiple opportunities essentially because social audit is one key factor in today's audit requirements and disclosures. There have been very large professional organizations, chartered accounting firms, who are essentially focused on this. Incidentally, one of them I know who is reaching out to people like you who are professionals for being enrolled as partners with respect to social audit. They are both, they are not only trained but also enable an opportunity for such social auditors. It is more related to how the company is performing with respect to the social aspect of the things. Like I mentioned about the garment industry, the banking industry, or for that matter, the education, edutech industry, where a lot of things are happening. So all of these essentially have to be looked at from a social audit point of view. For example, companies involved in a priority sector where they essentially look at funding microfinance customers, groups, women's self-help groups, so on and so forth. The social auditors are also expected to look at the impact of those financial interventions by the banks, so on and so forth. How are they impacting that particular portfolio? There is a gentleman by name Alok Kaushik who's asked valuation of solar, renewable, hydropower companies, telecom companies. On one hand, they appear to be helping environment. On the other hand, they have damaging effects on environment, like manufacturing of solar involves huge environment effects. Absolutely true, including the afterlife disposal. So there are two things here. One is the manufacturer of these, the manufacturer, EPC, or the solar panels, so on and so forth. The approach to value them versus an approach to value the beneficiary of using these assets is too different. There are up to different sides. Yes, you have to be very sensitive to valuing the solar, renewable, hydropower companies. They are detrimental to environment in a way. On the other side, we look at the users or the beneficiaries of these assets from a very different lens. Someone asked, Sheshadri Lakshmiraran, what is generally the premium range attached to ESG risks in valuation? Some of them put 2%, some of them put 5%. Some of them are looking at essentially discounting the existing price to equity, price to earnings multiple and a factor. There is no set rule. There's no range with respect to. There's no regulatory range with respect to these. Yeah.
Ramakrishna sir, this is Vijaya. Can I launch poll questions?
Yeah, madam. Please do that. Yeah.
Yes, sir. Yes, sir. Thank you.
If there are no questions, please go ahead.
Okay, sir.
There's a demo for tool also, right? That is.
Dear participant, the poll is running. Please give your valuable answers.
Excellent. Fantastic. Yes, ma'am, you can go ahead with the next question.
Yes, sir.
Actually, why there was no choice for all of the above?
Ah, that's a good question. I'm not. I should have done that probably, because that is there could be someone who is doing all of the three.
Thank you.
I feel all of them are equally important.
Yes. All of them are equally important, sir. Right. See, the assumption was that not many of them look at all of these, and hence we had. It is very useful. We will take necessary steps on this.
I assume that say you have considered that particular choice is there. Say environmental lapses will attract penalties.
Yes.
So I feel that that is the reason why you have chosen that.
Yes, precisely. So there is a little bit of influence also in this question. Please don't.
And moreover, it is visible. The
For us,
lapses are directly visible. But
more
whereas
importantly,
social and environment may not be so much visible to the naked eye.
Correct, absolutely, because materiality is very important.
Yes.
In this whole piece.
Vijaya, has the third question been reflected? Because I'm not able to see that.
Ma'am, it's already launched, ma'am. Ended also. Kusum, ma'am?
Okay, maybe I missed it. I was not able to view it.
Okay, now it is viewable.
Yeah, the fourth question is visible now.
By any chance, Kusum, is any pop-up blocking or anything enabled on your browser?
No, I'm just checking that. Let me just check.
Madam
Yeah, I'm
Kusum,
able to
one
view it.
request. Madam Kusum,
Yes, yes, sir.
one request. I am trying to join from my mobile. If you can allow me to join, because there is a likelihood of my power getting shut off.
Okay, Vidya, can you please address that?
The results
Sure,
are
ma'am, sure.
disappearing soon, very soon. We are not able to view them.
Excellent. Very good.
We could not really rate in this particular question. We only
Yes,
had
this
a
was
single one.
this I think is a wrong way to approach this question.
Yeah, the question is a little
It shows there is
labeled properly.
only one single choice is to be chosen.
Yes. Board accountability, environment degradation, climate change. Good. This gives us a lot of insights. Thank you. There could be a little bit of anomaly in the framing of the question. Sorry for that, but we'll try to address it. Thank you. That's great. Excellent. Thank you so much. Fantastic. I suppose all the questions are done, madam?
Yes, sir.
Thank you. Now we can, Shamant, if you can take over from here.
Sure, sir. Yeah, I'm just sharing my screen. Okay. Sure. Thank you so much, everyone, for this opportunity. So I will not be delving into deeper details of the platform because it is quite comprehensive in itself. But for the purpose of this session, I will be taking the case of BRSR, and just I'll be taking you through the entire process of identifying relevant material issues, how exactly you would be able to define KPIs for your analysis, streamline stakeholders for data collection, compile all the relevant set of data, and validate them. And finally, once you have all the relevant data points with you, how exactly would you process it so that it would be meaningful for you to glean insights from it and utilize it readily for any sort of uh, incorporation into your valuation practices. So before actually delving into the platform, I would just like to share with you how the exact workflow is structured within the platform. So anyone who is onboarding onto the platform for the first time would be either the sustainability head or the company secretary or the chief compliance officer. And for the purpose of the platform, we would call this entity the company admin. Now, once the company admin identifies relevant parameters, KPIs, and finally the set of data points that they need to manage on their end, they would again have to source data from a host of different stakeholders, because again, ESG essentially encompasses entire value chains as a whole. So again, any company admin, whoever wants to source data, they have three broad categories of stakeholders that they want to deal with. First is the departmental spokes at the company level. For example, say there is the IT department, HR department, environmental, procurement and stores, etc. Next, we have the site level spokes. So any company which say has 8 or 10 operational units spread out across the country or even otherwise, they would again have to appoint spokes on each of these sites to collect site level data. For example, diesel consumption or electricity consumption, water utilization at each of the sites, specifically if it is a water stressed area, all of these. And the third category of stakeholders would fall under the category of supplier company. So again, for the nomenclature, we have used supplier, but these are essentially value chain partners. Again, right from the sourcing of the raw materials, right from cradle to gate, as well as from gate to grave, end of use of the products that have been produced by the particular company. And additionally, each of these spokes would be able to further delegate their set of data points within their departments. For example, if I am a HR head and if I have been provided a set of questions from the company admin, I would be able to assign these questions to 2 or 3 associates within my department. And as and when they are providing the responses for these data points, I would validate them and then pass it on to the company admin for a larger level of audience. And additionally, apart from these workflows, for the validation part, we also have an internal as well as an external auditor to be could be invited to the platform to perform respective functions. So again, it is as simple as you would be creating one user type for each of them, and they would receive login credentials on their mail, and they can directly come onto the platform and carry out their functions. So now coming onto the platform, this is the dashboard page. I have logged in as the company admin. And as I said, for this particular case, we are considering BRSR. And what usually happens is once the company admin newly onboards onto the platform, they go to the ESG reporting section and select what are the necessary frameworks that they want to resort to. Now, here, the critical thing is for our platform, we have incorporated majority of the global ESG frameworks, such as GRI, SASP, TCFD, CSRD, ISSP, etc. And for this case, we have selected BRSR. And again, based on the frameworks that have been selected, the platform would suggest a set of focus areas or the topics for us to collect data on. Again, just to give you a better insight on what these focus areas actually reflect, because BRSR on a standard term, it has 9 principles, and the 9 principles are defined as shown on the screen. For example, principle 5 is related to the HR policies, how the business respects and promotes human rights. And principle 6 reflects the environmental operations of the company. So any efforts taken to protect and restore the environment during the course of their core operations. So if you take a look, say for a simple IT company, then principle 5 as well as few aspects of principle 6 would be material. Again, I'm not considering the compliance requirement, because based on the compliance requirement, every company would have to follow all the 9 principles. But if it is on a voluntary basis and if the data points are utilized for valuation purposes, then these are the relevant points that you might want to take cognizance of. And once these focus areas are selected, now beyond the 9 principles that have been prescribed by BRSR, we also have market intelligence as an added focus area. Because as I said, the raw set of data points that are prepared as part of the BRSR report cannot be directly utilized for any sort of analysis or taking out insights. So we would need to provide a good context for any point of data that we are taking up as a process of benchmarking against each company's sectoral peers, how they are faring on each parameter against their sectoral competition. So I'll just take you through that process as well, going ahead. So once this is confirmed, they are taken to the sector questions, which is actually the final set of data points that the company needs to follow. So for BRSR, on a standard term, we have 180 data points for the company to follow. And for each of the data points, say we have an option to upload attachment. So again, this serves 2 purposes. One is it helps companies to maintain a digitized evidence trail for any sort of third-party audits that are being thrown against them. Or the second major use case is, suppose there are any discrepancies between the company's own policies, charters, or statements and the data that they are providing for this particular use case, then that would get flagged, and any such digging can be made to probe further. And once these are in place, now the company admin himself or herself would not have access to all of these data points. So what I simply will do is go to the settings, go to generator. Generator is a way wherein I define the different operational units or the different offices that have spread out across different geographies. And based on these, I will create different sub accounts. So we have a comprehensive set of user roles here, including subadmin, internal and external auditor, any consultants that the company might be working with, data admins, any supplier assessment in charge. These are again the value chain partners, trainers, and finance managers. Now coming to the objective of trainer, because ESG and all of these reporting criteria is fairly new for majority of the companies that we are dealing with. If you say align 10 or 15 questions to different spokes within your company or even across your value chain, they would not have a thorough understanding of what kind of data points to feed in or how exactly to go about furnishing complementary evidence for the data that they are providing. So for such cases, we are providing a ready learning management system as well. So where we have framework specific as well as focus area specific courses or ready reckoners that any sort of stakeholder would be able to go through before feeding in data. So this just acts as a ready reckoner for all possible stakeholders across the value chain whenever we are collecting data. Once these are in place, the company admin would be able to see from which user and which company at each date how many questions are being responded. And the reason for including company here is again, given that it is a value chain wide solution that we are rolling out. Any responses coming up from different value chain partners would also be stored under a single window for easy management. And for each of these sets, I would be able to see the responses. I would be either able to accept or reject along with the provision of responses. So that particular stakeholder would get a notification saying that a particular question has been rejected and the reason for rejection as well. So this is just a simple maker-checker arrangement that we have maintained. And this would again be reflected as in the audit history. And the core reason for including this is to maintain an audit trail across the entire value chain. So any third-party audits or internal audits that have been conducted on the particular question can be seen in the history. And notwithstanding only the audit module, this is only to ensure that any sort of data capturing specifically for ESG parameters are validated enough before they are being incorporated into any sort of valuation methodologies. And yeah, so now that all of these are in place, once all points of data are validated enough, everything is accepted by both the internal and external auditors, the company would be able to prepare reports out of it. So just to show you the sample BRSR output that is prepared by the system. So this was from one of the previous year publicly available reports that we just plugged in the data and saw how the report is coming through. So this is the final BRSR report in the SEBI prescribed format. Now, if you take a closer look, the report in itself does not bring in any sort of actionability, or you would not be able to draw much insights from the report directly, because these are just carried out as a disclosure exercise by companies from a compliance point of view. So to make it more relevant for valuation and to better glean insights out of this, we have incorporated market intelligence, as I did mention. So this is a simple market intelligence report that comes out of the system. And this is the report that we prepared for Apollo Tyres BRSR report, publicly available one, which was published on July 10th. So if you see for each of the parameter in BRSR, for each of the quantitative parameter, it would show what is the score, performance of Apollo Tyres, what is the sectoral average, and in what position do they belong to within their sector, say within the first quartile, second quartile, third quartile, all of these sectoral positions are also highlighted. And finally, if the company wants to reach the top quartile within their sector, what is the ideal target that they need to keep? So these are the level of insights that the system provides. And again, the sources of data is on the NSE, we have around 400 publicly available BRSR reports. The system automatically scrapes through all of these reports. It would categorize reports into different sectors. And because Apollo Tyres belong to the automobile sector, it would benchmark the performance of Apollo Tyres against other automobile companies within India. So just an example, say the turnover rate for Apollo Tyres is 30%, and the sectoral average is only 16%. They fall under the fourth quartile. And to reach the top quartile, they need to keep a target of reaching 8% employee turnover. If not, this data can just be an overview reflection that the employment policies are not very conducive to mitigate the turnover rate of within their company. So this might potentially hamper the operations of Apollo Tyres going forward, be it in terms of labor shortages or unrest or any other such occurrences. So this is how we would be furnishing the final set of data points for each company by giving it context. So I just wanted to highlight the entire process of identifying relevant parameters, streamlining different stakeholders, as well as processing the data that is coming through by giving it context, either in terms of the regulatory mandates of threshold parameters or in terms of the market intelligence based on the sectoral benchmarking. So I would just like to take a pause and welcome any sort of questions, inputs, or feedback.
My name is Lakshmi Narayan from Chennai. What is
Sure,
the cost of using this tool for a company?
Okay, so again, sir, the cost, it would again depend on the nature of frameworks that are being incorporated, the level of number of data points, as well as the number of stakeholders that you would want to incorporate.
No, I see the simple point is it's only, as it stands, it looks like only a BRSR.
No,
And how many data points at this stage, I'm not in a position to tell you. But
Right.
when you say, let's assume that everything is to be taken into account, what will be the cost of this tool?
Again, based on the size of organization, it could cost anywhere between 3 to 6 lakhs.
Okay.
Yeah. And again, it is not restricted to BRSR. We also have GRI, SASB, TCFD, CSRD, all the major global frameworks incorporated.
No, frankly, if you say everything to the company, they will be running away from BRSR.
Right.
Now, at this stage, I think it's very difficult for everybody, especially a company who is beginning,
Yes.
to even think about all those things. BRSR, yes, now it is more becoming a compulsion. People are now talking about it.
Sure.
See, you please kindly share your mobile number before you leave. Okay, thank you.
Yeah,
Absolutely.
definitely,
Absolutely.
sir. Sure, sir.
I think what we as valuers have also realized is the BRSR report can be an important source of information from where we can understand the risks of companies, right? It's an additional source of data and good to analyze.
Excuse me, sorry, this is Lakshmanan again. So your number vanished. So, okay, Mr. Ramakrishnan, your number is there. I'm seeing now. Please, I'll call you maybe after some time.
Absolutely, sir.
Sorry, please repeat your number, sir.
We will share, sir. Lakshmanan, sir.
Yeah.
Shamant, you have, please, I will share. Just a minute.
Yeah, you can share.
Is it visible?
Yeah, it's.
Yes, sir, it is visible.
Yeah. This is Shamant's number. 888 is Shamant's number. The other one is mine. Yeah.
So thank you, Mr. Ramakrishnan and Mr. Shaman.
Yes.
I kindly request Mr. Subraidu to extend the vote of thanks on behalf of BVA and all the participants this morning. Over to you, Mr. Subraidu.
Before that, I must admit that it has been an overwhelming response. 40 people plus have joined, and I'm thankful to the association for having provided us with this opportunity. Thank you. Yeah. Subraidu, please.
Yeah, thank you, Mr. Ramakrishnan and Shamant and team. This was a really very, very completely different session and goes into a direction which perhaps many of us would only have read a little about somewhere, and always there was curiosity to know a little more. But I was particularly noting the initial few slides and that you're presenting, Mr. Ramakrishnan. They are very, very emphatic, very, very deep, and they reflected the tremendous amount of experience and expertise that you might have had in that area. And one felt that, it just, as you said, scratching the surface
Iceberg,
and,
tip
the
of
tip
the
of the
yes,
iceberg.
absolutely, absolutely.
Yeah, and I could also notice the amount of struggle that you might have had in capturing your complete experience in a few crisp slides and few crisp sentences. But yes, I think the essence of it was ascertaining the risk and the risk in cash flows, including that risk in the computation of an appropriate rate of discounting for the cash flows. And what I particularly liked was the slide where you showed the adjustments to the ESG adjustment to the free cash flows.
Correct.
Most of us are used to making valuation adjustments for different factors after you arrive at a total value. But I think that spreadsheet is extremely useful in giving direction as to how to incorporate ESG parameters into the computation of free cash flows and all. And I think I see great opportunities for BVA to collaborate with your organization in terms of perhaps creating certain case studies in how to incorporate ESGs. And although it seemed to be some few of our members might already be incorporating ESG parameters, but by and large, I can say that a lot of us would not have even thought of incorporating ESG parameter into valuation due to various reasons.
Thank you.
And I think this would also serve useful for, I see a lot of people, BVA members, passing the social auditors examination, and the opportunity for social auditors to collaborate with you.
Absolutely.
I particularly like the slide where you had pointed opportunities for, valuation of carbon credits and, different consulting and advisories that valuers can potentially offer to their clients.
Yes,
a lot of opportunities. Let's hope we have a very fruitful association.
Absolutely, and I would also recommend maybe we could collaborate to create tools for BVA. Basically, that is a very essential part. Okay, the scorecard mechanism or inbuilding the tools within valuation models, so on and so forth, right?
Yes, and I'm also thinking that we have to collaborate to work on the research bit of it. I think that is
absolutely that is very important. Yes,
all of us come with diverse backgrounds and rich experiences. We can actually pool in the knowledge together to create a database.
Fantastic, really
maybe a
appreciate.
Physical workshop that we're Shilpa, you announced December 15th or 16th physical. Maybe we should dedicate some time or 2-3 hours for a session by Mr. Ramakrishnan and his team.
Thank you so much.
In an online session and in an hour and 2 hour session, there's a limited amount of justice that can be done. There are a lot of questions, a lot of additional stuff that can be exposed. We look forward and work towards
thank you so much.
Session there. Because and the other thing that I noticed, Mr. Ramakrishnan and other members of BVA also, that this is not something that is useful for just securities and financial assets values, because I think there is a scope for even plant and machinery values and even
yes, absolutely.
Values to
asset valuation is a very significant part in this. Very important, very critical.
Yeah. So, in fact, we just a couple of days ago, we are brainstorming on how to hold these offline session, and a workshop is being planned. We are thinking this is a session that will be of interest not only to SFA values but also to land and building and plant.
Absolutely, yes, absolutely. I think Mr. Subraidu has frozen for whatever reason.
Just time. Thank you very much, and
And on behalf of Bangalore Valuers Association, sir, we are presenting this memento to you. It will also be couriered to you shortly.
Thank you so much. This is really wonderful. Thank you. I must appreciate it. Thank you.
Yeah, and as Mr. Subraidu was mentioning, we hope to have a physical session with you, and where we'll get to meet you and interact with all, with you,
all of us.
And the valuers, and of course, we can actually, there'll be more takeaway for all the valuers, because you carry immense amount of knowledge and experience.
Thank you, ma'am. Thank you so much. Thank you.
Thank you very much, sir, and thank you all the participants for sparing your valuable time this morning and participating in the seminar.
And we wish you all a very good weekend. Thank you very
And
much.
this is amazing. 9:30 you are completing. This is really amazing. Thank you so much.
Thank you so much, sir. Yeah, Vijaya, you could stop the recording and end the session, please.
Sure.